Hi guys, so welcome back to today's video. So today's topic will be about Warren Buffett's top 6 rules of investing. So I'm sure as many of you know, Warren Buffett is one of the best long-term value investors out there. And to put things into a clearer perspective, if you had invested $1,000 into Berkshire Hathaway, his company when he founded it, he didn't found the company, but when he took over the company, you would have over $21 million today. So even with the market crash, till date, his annual return is around 20%, which exceeds the S&P 500's annual return of about 10%. So I'm not saying that he is the best investor and that you must abide by everything he says or follow him like he's the only investor out there. But here are 6 principles that guided him to his success, and by sharing it with you all, I hope that you'll be able to give you all some insights and might help you all to be a better investor. So the first principle that he abides by is cash is never a good investment. So this is something that I personally agree with because assets are always more valuable than cash itself, because due to today's day and age, inflation is rising so rapidly. If you just leave your money there, sitting there in the bank or at your house, it's just going to depreciate and the value is going to be different 10 years later compared to now. You just need to make sure that you have enough cash lying around when you need it, and which is why that's the reason why you need the emergency fund. So other than that, you don't need an excessive amount of cash. You can instead invest most of your cash into valuable assets and let it grow, and that way your money will overcome inflation, and instead you will constantly be rising at a faster value compared to the inflation rate. As long as you have a good budgeting strategy, and then you use the rest of your cash and invest it away instead of keeping it in a bank, that will definitely be much better than holding cash itself. However, there are of course exceptions where, such as for example this year, when COVID-19 struck, there is a volatile year in the stock market. So different people might want to keep a little bit more cash because firstly, they want to avoid having their portfolio crash during this time. And another reason is that if you have more cash, you are able to buy into great stocks at a fair price when the market crash, and you are able to buy them at an undervalued price. So the second principle that Warren Buffett lives by is he invests in productive assets. So what that means is that Warren Buffett is not a firm believer of investing into gold. So he believes that no matter how much gold you have, yes, you could buy so much gold that eventually forms a mountain. You're able to sit on top of the mountain and feel like you're on top of the world. But at the end of the day, that gold isn't going to do anything. And all you're hoping that somebody else, a year from now, 5 years from now, 10 years from now, value that gold more than you bought it today. And so essentially you are betting on someone believing that the economy is going to crash, so they want to buy gold and they want to buy it at a higher price compared to the price that you bought it in. Productive assets, on the other hand, don't have to have such assumptions or such worries, because they will always be producing a certain amount of goods and services that will be generating revenue and in turn generating profit. So you are in turn buying into the asset itself and how much you think that asset can produce and how much income that it can generate. So there's a logical flow to it where you are buying into how much you think the company is worth, and you will be able to have a calculation to be able to calculate the intrinsic value of the company, as compared to gold where essentially there is no value for you to calculate because it just depends on market sentiment. So personally, I think that this principle really varies depending on different individuals and their investment beliefs. Personally, I do invest into gold, but purely as a hedging purposes, which is to hedge against my stock portfolio. So that way, in the event that the economy crashes, the gold price will rise and it will sort of hedge the amount of losses for my stock portfolio. So the third principle that Warren Buffett believes is that staying in your circle of competence. So what that means is that you don't have to have a very huge circle of competence, and in fact this is one of the most important aspects of investing. You don't have to be an expert in everything. Instead, you should know where the perimeter of your circle is and understand what you know and what you don't know. You have to be able to understand what you know, because through that you are able to invest into an area or a topic or a certain industry that you're better in. So you don't have to be a genius, but instead you just have to be smart in certain spots and stay around the spots that you're good at. So, for example, you should not invest into something that everyone is raving about, or something that seems exciting in the market, or when something that your friend starts talking about it, and then you start to throw money into things you don't understand at all. So instead, you have to choose into each asset vehicle that you're more familiar with. So for example, stocks, real estate, startups. So then from within, you narrow it down even further. So for example, within the stock market, there are different industries such as consumer staples, technology, oil and gas, plantations, etc. Out of all these industries, it's not possible for you to be an expert in everything and fully understand all types of companies within each sectors. So instead, you should choose a few that you are good at, proficient at, or a certain industry that you're more interested in. So that way you will be able to focus well on these few industries and really understand what are the companies that are undervalued within these industries. So the fourth principle is evaluating companies first. So this is in line with the third point of circle of competence, where you can't think like the average person when you're investing. So what an average person will think when they're investing is they'll look at the stock price and think that, oh, it's so expensive, so I should wait for it to drop further before I buy, or it's too cheap now, there's no momentum to it, I should wait for it to grow more before I buy. Eventually they will just look on and watch the stock prices grow from $100 to $500 to $1,000, and they'll still never get into the market. So whenever a stock comes to your attention, don't just get into it and get all excited into buying it. Instead, do your own due diligence and always do your own research and figure out how much the stock or the company is actually worth. Don't go ahead and look at the price first and let the price influence your decision. Instead, you should go into the fundamentals and look into how much the intrinsic value of the company is, and if the current market price is above it and the company is undervalued, then you should buy it and let it grow. Whereas on the other hand, if you think that the company is overvalued, then you should wait for it to reach a better price before you buy the stock of the company. The fifth principle is play big and don't waste opportunities. So there's always opportunities in life and you wouldn't want to waste them away. In fact, good opportunities don't come by very often. So whenever a good chance to make a great decision comes by, you should grab onto it and make the best out of that opportunity. So Warren Buffett has this saying where you should invest as if you only have a punch card and you only have 20 punches throughout your whole life. Because if you think that way, you will know that you are only able to make 20 major financial decisions in your life. Then that way you will be a lot more careful when investing, and you won't be throwing your money into places that they shouldn't be at. So I do agree with this, because instead of investing into companies that you heard about at a party or where your friends and family have been talking about it, and then you can't even properly remember the name of the company, you're not even sure what their business model is, and then you choose to invest into a company. So there's always a temptation to dabble around in the market, particularly during bull markets, because it's just so easy to make money. So especially in today's day and age, with just a few clicks of the button, you can buy into a stock. A few days later, you're able to see that the price has went up and you have made some profit, and then you get all excited about it that, investing isn't difficult at all. That shouldn't be the case, because you should always make sure that you're able to understand when opportunities come by and not let it go to waste. So one good example will be during this year, where in March and April, the market sort of crashed quite rapidly. So if you had taken a good advantage of this opportunity, you have been able to bought into a lot of great stocks at a very undervalued price, and till today you have definitely made a lot of money over that. So the last principle that I'll be going over is investing in yourself. So personally, I really believe in this as well, because the best investment you can make is onto yourself, because nobody can take it away from you. Inflation can't, taxes can't, nobody can steal your knowledge and skills away from you. That's essentially how life works. If you're $1 million asset, people would eventually pay you $1 million for the value that you can bring to this society. So what you can do now is to start increasing the value that you're able to provide and how much you are valued as an asset per se. So constantly improve yourself, be it through soft skills like communication skills and presentation skills, or technical skills such as coding, digital marketing. Any of these things that can increase your skill sets and knowledge. So not only do you have to develop skills, you should also develop habits that will make you successful. So you look around at people you admire, people that you look up to and successful people that you can emulate them and learn from them. So don't look at successful people and think that, oh, they're so fortunate to be there, they come from a well-to-do family. So I'm not saying that these don't play a part in their success, but definitely there are things that we can learn from successful people despite their background or whatever kind of luck they might have in their life. So if you choose to look up to different people and emulate their different habits, eventually you will be able to constantly improve yourself and absorb more knowledge from these successful people in this world. So with that being said, we have come to the end of the video, so thank you for watching. Please do leave a like and comment down below as to what other upcoming topics that you wish for me to talk about, and then also subscribe to our channel. So thank you for watching and see you all in the next video.